Welcome to Founders Unplugged, hosted by Greg McCallum. Long-form, honest conversations with founders and entrepreneurs from around the world. This is part 2 of this episode. Be sure to check out part 1 if you haven't already. Link in the description.
I wanted to ask you then a bit more about. Well, actually, I had one quick question regarding BizCrunch. Last one on BizCrunch and that sort of topic, and then I'd love to hear a bit more about BlockDojo. Kind of again working our way backwards a little bit. But yeah, in terms of due diligence, there's always been a really interesting subject for me, especially as I'm not going to go into it, but my startup is going to be somewhat involved in that space to a degree. What are some of the sort of pitfalls of the due diligence process right now? What kind of slows it down, makes it bloated, makes it expensive? And how are you hoping sort of BizCrunch could help with that?
Well, so due diligence, you can look at as being a fairly consistent process. You know, you're doing your financial, operational, contractual, human, you're doing the different types of, and obviously legal, due diligence to ascertain where the risk is. And yes, there's a checklist, and depending on sort of the deal value, that might be a longer checklist for the bigger risk and a shorter checklist for the sort of more lower risk, less skin in the game type deals. But it is where the difference between fast and deep due diligence is probably down to the data room and down to the depth and the structure of the data room. If you're, as an acquirer, having to keep going back and asking for things in order to be able to check them off because the seller is unprepared, that's just going to take longer. There's more iteration, there's more cycle, probably not more cost because the lawyers aren't necessarily involved in that. Because if you're a savvy buyer, you're only really bringing in the lawyers when you've got full comfort that you now can press ahead with getting the paperwork sorted, and you've seen all you need to see to make to press ahead to go ahead with the transaction. So a really good, really well structured data room, and the problem, one of the key reasons why so many deals fail. Is that the sellers are unprepared, right? So the lack of preparation means that they don't necessarily know what they're getting into. So the syntax, the glossary of terms is unfamiliar to them. The deal structures are a surprise. The valuation multiples that are the norm. Because they haven't necessarily valued their company according to how companies are traditionally valued. They've valued it on the basis of how much blood, sweat, and years they've put into it, and therefore they're expecting it to, despite the fact that they've had most of the profit out over that period through dividends. Actually, they're expecting the company to be 6, 8, 10x earnings, and it's just not how it's done, right? The UK average is 1.8, I think. So if you're getting more than that, well done. Unless you're a software company, in which case it's a magic money tree. But allegedly. But if you're a traditional business, then that's what you need to calibrate to. But so many sellers go into this process not necessarily knowing how businesses are valued and what they should expect and what they should have done with their businesses to make them sellable. So, right. At BizCrunch, we have a seller side product, which is a whole preparation program for business owners that want to consider selling their business. What do I need to do in order to make my business sellable? So, what do I need to do? Well, you need to get comfortable paying corporation tax, or at least being able to prepare a set of accounts that show what the seller discretionary earnings are, because you've pulled out a load of let's say parochial costs from within the P&L, because a lot of companies are run as lifestyle businesses where the owners are saying, well, part of my compensation is I can build this, that, and the other through my business, or I don't have to take a true wage through the P&L. I can earn on dividend and pay less tax, and that's all cool. But you need to be able to demonstrate that narrative to the buyer, otherwise it's going to look sketchy. So it needs to look deliberate and explainable. So there's that piece. There's how do I manage the financial presentation of my business, but there's also the what am I about to start navigating, and how dependent is the business on me? So what often comes up through due diligence is, oh well, the seller said that actually they've got a team that's leading this and they don't need to be involved day to day. but actually they haven't really extricated themselves from the day-to-day. They're still very much wound up in the business. They're the nexus, the hub. And that's fine, but the buyer needs to be prepared for that. So there shouldn't be any illusion. The seller shouldn't be saying one thing and then the reality being another, because that breaks the deals up in due diligence. So we at BizCrunch have this kind of like, look, here's the process you can go through to demonstrate just how exit ready the company is and how independent of you as the owner it is. And if it isn't independent of you, you need to have a roadmap to make it so, probably even during the earnout period. Like this is how, for my first 100 days, I'm going to hand you the reins and I'm going to be there shoulder to shoulder to help you.
Right. It doesn't kill the deal. There just needs to be a plan.
Shouldn't kill the deal, but it does kill the deal when it comes as a surprise. Because if they've gone in, Johnny Big Banana's going, oh, actually this business is a machine and it's got nothing to do with me anymore. And then it turns out in due diligence, it's 100% your, day-to-day involvement, your motivation, your strategy. Then, just be upfront about it, right? If you haven't operationalized your playbook, if you don't have SOPs, if you don't have, quarterly management meetings or monthly management meetings where you're hearing back from the workforce rather than them hearing from you, today we're going this direction. There's those kind of things that indicate whether a business is mature enough to pass into new ownership or not. And some buyers, and many buyers, will come in ready to help with that, but they'll want a coupon, they'll want a discount on the deal, because the company, that attracts risk, right? The company is not 100% exit ready. So there's an anchor on the valuation, or there's a significant add-on to the earnout, so that it's de-risking it for the buyer to some extent. So you can remove all of that, negative effects on your valuation and negative effects on your deal structure by just being more upfront about things, or better still, solving it so that the company can survive you and is independent of you, and then it's fully exit ready. So there won't be that beta on the valuation. So that's there. And then I guess another thing that kills deals is what you'd call in private equity circles retrading, which is trying to renegotiate it after the hand is shook. We've sent the letter of intent. This is what we've offered. You've co-signed it as the seller and said, yep, we're interested in proceeding under those terms, non-binding. If you think, oh, we'll make it up in the edit, we'll get it in the post-production, as in during the actual negotiation when people are emotionally committed to it, you're probably in for a bit of a surprise, because if you pull the rug on the buyer and say, oh, actually, now the deal is, I want more, or I found this additional thing that I want to work into the value, it's going to jeopardize the deal. But again, it happens too often on the other side, where the buyers go, oh, this guy's committed to selling now, I'm going to screw him and have try and get 20% off the price. It happens where you can justify it because there is an increased risk, or there is an increased gain. Great, have the negotiation, but really you should know exactly what the picture looks like before you press the button and go into due diligence and go into certainly before you engage the lawyers, because then it gets really bloody expensive.
What I most commonly hear that affects evaluation in a downward sense from the buyer's perspective is quite often pipeline reviewing or auditing. That seems to be quite a common one. So the pipeline is valued at a certain amount in the initial stages, and that's given to the buyers early on in the negotiations. But then actually in the due diligence process, it transpires that actually a deep assessment of the pipeline isn't actually what it was claimed to be, and it isn't valued at what it was claimed to be.
Why are you attaching any value to pipeline?
I don't know. That's just what I hear.
Oh, okay. I mean, yeah, that's creative accounting, that one.
Right, okay.
I mean, this is where the sort of capitalist in me comes out a little bit stronger. But if it hasn't already been proven, if you haven't got revenue from that customer, then I would discount that pipeline, because it isn't a deal until it's a deal, right?
Right.
So EBITDA is the kind of the last piece, or you could argue maybe cash is the last piece, where you've actually had your credit cycle and you've been paid for the work you've done, but you've written it into your P&L at the point of invoice, right, as a sale. So at that point you can calculate what your your net earnings are from that transaction. And if you do that in aggregate, then you've got proven earnings from the work that's been carried out. Pipeline is the other end of the spectrum entirely. It's the very beginning. In fact, it's before the beginning, because it's like the promise of the future. If you're paying for pipeline, you're a mug.
Right. Okay. Interesting. Fair enough. What about excuse me? What about you mentioned about people as well, and that was kind of what we were talking about in part one or earlier for us. About people, and obviously that's a hugely interesting section for me. But like, how does sort of evaluating skill and competency, and to some extent sort of team dynamic and things like that, factor into things like valuations and the due diligence process? Is there much of a structured way that occurs in terms of evaluating that at this stage?
I don't think it's part of the standard playbook to assess the deep competence of the lower rungs of the team ladder. No, I don't think enough time is spent on that, and I think, again, where do you put your effort in time, because time kills deals. How much do you need to see? You need to know that these people are contracted. You need to know length of service. You probably need to know what their job entails. So I like to see JDs in a data room, not least because it shows that there is actually a structure to the organization, that people have clear remits and clear responsibilities. So, a company that's taken the time to write JDs for its roles and has put it into an org chart and has said, hey, this is how our business functions. And if this person was to die or leave or retire, actually, this is what we would want the person that comes in to do. Like, you'll be surprised how few businesses do that.
Yeah.
But, if you're trying to build a sustainable and scalable business, you are going to write JDs, and you're going to have an org chart, and you're going to work out clear lines of communication. So, I mean, that you can assess. The competence in the role and the team dynamic, that's something you learn after the fact. I mean, what do they say? Due diligence always happens, just not always before the deal closes.
Right.
And there's a lot of learnings after the ink is dry and the money is wired and you own the equity. Great, now you're really going to diligence the company, because you get to see what you bought. And
right.
the cupboard is what laid out
the
for
org
you.
chart says people are meant to be doing, and what people are actually capable of doing are very, very different things, right?
Yes, and remember, of course, also you're not always. In fact, you're very rarely able to meet the team, because the seller doesn't want to disclose that they're selling the company often, right? They don't want to destabilize the workforce. Largely, often because if the deal falls through, they don't want to have to go back cap in hand and say, oh, false alarm, sorry, this business didn't actually manage to sell.
I love you, really.
Well, yeah, well, but also we are running a viable company. We are doing that, we are trying to fulfill a purpose here. You don't really want to create that. It's a real emotional roller coaster for the sellers that are on that journey, right? It's off until it's on. The whole thing could just flick off in a moment where someone just walks away from the table and says, oh, no, this isn't what I thought. Okay, deal's off. And so you don't really want to have to socialize that with your team and make it their problem, okay? Because if they're not equity holders in the company, then they don't need that in their life. Because it is so volatile, you don't want to necessarily waste the time of the team. So the buyers aren't getting to go and interview the team and say, hey, is this org chart real? And is this what you really do? And tell me a bit about that. Just doesn't happen until day dot when you own the business. And that's part of the fun.
Fair enough. So listen, I'd love to hear more about your the Sherpering that you do at BlockDojo. So yeah, tell me about BlockDojo and what you do there. It's a really interesting. As you know, I've spoken with them before as well. They're super interesting individuals. So yeah, I'll leave it to you. Tell us more about that and your involvement there.
It has been a super interesting journey for me, and I love my time with them. We have managed to launch 65 companies into the world over the past few years, of which about 58 are still actively going and doing their thing, which is great. And I would say about 16, 17 in amongst that are really off to the races. So certainly better than your normal batting average at pre-seed, which is good to know. I think our multiple of invested capital is something like 11.5, 12x greater than it was. So that's not a bad return on paper in 2 years. But the program is the real jewel. To be frank, the program that Alex Ball, the program director, has put together, and Matthias now delivers in the UK at least, it's just incredible. It's such amazing value for the founders, because they get really put through their paces. They get help in validating their idea, in finding design partners and early customers to sort of try the product, to build the product. I mean, that's what BlockDojo have, engineers to help with the blockchain piece. They have front-end designers and front-end developers to be able to build out your UI. They take them through a session of no-code MVP building during the program, so you can actually get sort of a working prototype. So, you know, it's not just, here, leave this program with a Figma and, you know, 150 grand. Right. It's leave the program with actually a working product. So cohort 8 UK, which graduated at the end of July, was the first cohort, I think, to leave entirely with fully functioning products. And we weren't far behind that with cohort 7 either, where they'd gone from Figma to Bubble, I think, or whichever they chose to use at that point, and then on to an MVP. By the time they'd left the program, it's like 12 weeks. It's bonkers. So we do all that. We have an amazing financial modeling tool. So, you know, one thing that too many founders still overlook is getting deep into the unit economics of their companies. And so Steve and I put together this really deep, like multi-tabbed tool, which, you know, goes from a single setup tab of let's work out what your product is, let's look at the top of your funnel, let's look at your conversion rate, likely churn, upsell percentage criteria, and, you know, what's your unit economics in terms of margin or cost of sales, selling price, how are you going to spend, what are you going to spend on marketing, what's that going to deliver in terms of CAC and conversion, and then that all kind of works its way into a P&L. We do a hiring plan for them as well, so they work out what kind of headcount they're going to need and in what roles and by which months they're going to want to be onboarding X, Y, Z. So all of this contributes into a P&L, which then goes to a cash flow forecast, so they can very clearly see like what the existential moments are going to be in the company and how much money they're going to need to raise and when in the various different rounds. That converts to a valuation. So we have a multifaceted valuation tool which says, look, we take the Bohurst pre-seed average of 1.3 million pre-product and we say, okay, right, well, where are you on that spectrum, and what have other companies in your space raised that in the similar marketplace, plus what's the discounted cash flow valuation. So they kind of triangulate this whole value to calibrate to a sensible, justifiable valuation, which again, too many founders that don't go through these programs come up with these freaking harebrained, you know, I'm worth 5 million for an idea. Okay, mate. So yeah, they leave these programs much better able to articulate the moving parts of their model and what makes their business tick. And we build them up, we tear them down, we build them up. You know, there's a lot of, I mean, it's been actually really rewarding seeing so many founders come in that are really technical founders, but are almost introvert. I don't think you can be wholly introvert as a founder. I think you've always got to, you know, be willing to evangelize. But to see some folks that are really into the tech and not able to necessarily articulate the problem and the solution and the market opportunity, and they go through this 12-week, and by the end of it, they're absolutely transformed into like the best advocates for the product you could ever imagine. And they go out in front of this massive stage and a room full of 200, 300 people, and they just give their best rendition, and they be their best selves, and that's all recorded, and they get this great collateral at the end to be able to use in their pitch outreach. And so then the fun begins with me, because what I was doing is working shoulder to shoulder with them post their leaving the program to actually do the outreach and get on the due diligence calls and do the roadshow around the angel groups, and just, you know, have sensible discussions. And they only need you to, you know, be a companion with them for 1 or 2, and then, you know, they're off to the races because they've got the confidence. They know what they're going to expect. That trepidation about, oh, what's he going to ask me? That goes away, because, you know, probably by that point they're starting to lead the conversation and ask questions of the investor, which is great. You know, that puts us all at ease. So yeah, it's wonderful seeing the transformation. I personally think it's well worth, they come with an idea, we incorporate them. Yes, we're a 10% equity holder in the company at that incorporation stage, but we're fully dilutable, so we ride the journey with them. There's no poison pill in our terms. And yeah, we activate Google partnership with them. So we're a Google Cloud for Startups partner. So they're getting, if they're going to use Vertex Gemini as well, they're going to get best part of 300 grand's worth of cloud credits, which, for Firebase and for Vertex, that goes to good use. They also now, with Google Cloud for Startups on the partnership that we had with them, they also contribute a bit towards some dev in a Google certified development agency, which is incredible. So yeah, just getting access to that through the program is more than pays back the cost of the equity you would have had to have raised if you like to go and spend that money in the first place. And yeah, they get, we host some dinners and some lunches with a number of investors. They're probably in a room with a good 100 investors that are real investors, not so like some of these other incubators where they just bring the great and the good from the service provider community. And God, you've got to navigate. Oh, okay, this guy wants to have my shirt off my back. Or okay, this one wants to basically sell me dev services. Oh, okay, yeah, that one's a media company. Okay, where's the investors? So at our dinners, it's all angels and SEIS fund managers and people that actually can and do invest the pre-seed. So yeah, slightly more intimate than others, but actual real investors in the room.
Hi, a friendly reminder to share this episode with your network, like, and subscribe. And if you are feeling really supportive, please consider reviewing the show on the podcast platform of your choice. It all really helps support what we do. Thank you. Now back to the show.
It's amazing, and yeah, and for those listening that maybe didn't have the context beforehand as well, like BlockDojo is an incubator specifically for Web3 projects, right? So this isn't just for any startup projects. This is specifically those within the Web3 blockchain sort of space, right? So
blockchain and AI, yeah. So the model the model kind of evolved to where the congruence of blockchain and AI. So imagine like if you're doing stuff with smart contracts and you're going to have an AI agent that's going to be able to execute those contracts or make some kind of intelligent decisions. That nexus of those two emerging technologies is a massive empowerer. And so, we like companies that are going to use one, other, or both of those back-end techs.
Which is exactly why I was speaking to them, because of our startup is going to be using both of those in unison. Yeah, it's really interesting. And what sort of projects are you seeing? Like, because of there's been a lot of bad press, let's say, around Web3. So especially in the spaces involving crypto and NFTs. Are we seeing now? I think it's fair to say we hadn't seen for a while some innovative uses of the technology. Are we starting to really see that now? And judging by what you were saying about the last couple of cohorts, that's probably the case, right?
We've been
quite confident.
We've been, despite being a Web3 incubator, BlockDojo has been not the greatest proponent of crypto projects because it's got to have utility, right? The thing has got to be able to have a real business impact or commercial impact, and crypto. And not just a cash grab, and to your point, I think like a lot of emerging asset classes, there were those that were opportunistically bending it to their will and taking advantage of the naivety of the uninformed, and then there were also those that were just a downright criminal and have then gone on and served time. Sam Bankman-Fried for one of them. And
unfortunately, not enough of them have, but
no, although it's still early days. So I think we've probably got one crypto project, I think, out of 65 UK and 9 Manila companies. So it is. We've been very much about making sure that the Web3 is almost from a user's perspective inconsequential. That actually it's the rails on which the business is powered, but it's abstracted away so that the user doesn't have to be a degen in order to get value out of the product, right? It's serving a real function. So applications like the tokenization of equity is one that that's one that's recently graduated. We've got digital identity, so self-sovereign digital identity around, like, if you're applying for a job in the gig economy and you don't want to send copies of your passport, driver's license, etc., because you're worried about, well, A, if you're an employer, you're worried about GDPR risk, and B, if you're the candidate, you're probably worried about identity theft. So being able to use blockchain technology to be able to kind of give limited access without having to fully disclose and allow your documents to be duplicated and downloaded. So things like that. We've got property conveyancing being done through blockchain. We've got tokenization of real estate investment trusts. We've got pet identity, so pet passport identities, where if you're doing vaccinations and inoculations for your dog, believe it or not, like, traveling with a dog is really difficult around the world. And if you've got a dog, but like if you try and take it on an airplane, every country's got its different kind of.
It's too big to go on a fucking airplane.
Yeah. Okay. Yeah. Fair enough.
Yeah.
You have to send it on a Zeppelin.
Yeah. Yeah, exactly. But yeah, it's a pain in the arse, though.
It is a pain in the arse. Yeah. So having to, but then the record of the inoculation that's required in order to be able to show that transparency, it's all paper at the moment, right? So digitizing that and using the blockchain to be able to effectively have like a very easily queryable database of pets inoculation statuses, that's a game changer. So PawPass is one of the port codes that we've got that's off doing that. She's just emerged also having finished. I think she participated in cohort 5 UK for BlockDojo. She's just gone on to do Techstars. So she's well off to the races now, Julia. Yeah, great company. One you might want to think about interviewing, because she's had an interesting journey through the solo female founder space.
Right.
So that's PawPass. So I mean, we've got some fantastic companies. We've got a real-time computer vision with streaming of data through the chain about combat sports. So Combat IQ was an early cohort company that's just received investment from the people behind UFC Endeavor. So there's huge
I mean, I think
opportunities for this tech.
Yeah, from the beginning, I think we all knew that there were some massive opportunities and potential for blockchain, and in some otherwise fairly mundane, or just not thought of applications. But it's just, for whatever reason, I think, been massively derailed and got an enormous amount of bad press to push that aside from people's minds. But like you say, I think the key is to make sure that it is just part of the infrastructure of these solutions, but not at the forefront of them. It's got to be, like you say, almost invisible.
But you look though, behind the scenes of all of that, the technology is amazing, and behind the scenes of all of that, it's really got that institutional support. It's come of age now, the crypto space. Not all the shit coins and altcoins and stuff, but a select number of established cryptocurrencies, legitimate cryptocurrencies, and the blockchain technology that facilitates improved, more efficient global trade. That is off to the races with institutional support from the banks, from investment banks, from governments. So, for all what you see on the retail space, Christ, it's the Wild West, and a lot of folks have been rooked over by NFTs and that kind of stuff. And you caveat emptor. You've got to, there is no all that glitters, as I said, I think in a previous podcast. The governments are right, the SEC, the FCA are right to legislate to try and protect the retail consumer, 100%. But beyond that, you've got this huge utility being utilized now by the institutions because they understand the disruptive benefit that this technology brings.
Yeah, but I think we're going to see some huge game-changing things come out of that in the next couple of years for sure. And by the sounds of it, BlockDojo are doing a lot to contribute towards that. So that's great.
Doing our best in making a little dent in the universe. Yeah.
Yeah. And you have reminded me I need to get back to them as well at some point. So I will
do. In fact, applications for cohort 9 remain open.
Okay, excellent. Good to know. So listen, you said right at the introduction in part 1 about yourself that also part of what you have done and what you do is being involved in the angel investment space. So I'm interested to pick that apart as well. I'm pretty green when it comes to being an angel myself, and you're clearly more seasoned. So it's an opportunity for me to learn once again from you, but also I think for people to hear a bit about what goes on behind the scenes there, especially as most of the people that listen and watch the show are founders themselves, right? It's a nice way to pull back the curtain a bit there. So how did you get into it, first of all? What was your sort of entry point into being an angel investor?
So it was 2020. So I'm now 4 years in, and yeah, some of them are starting to bear fruit. So to my earlier point about patient capital, this isn't the sort of thing you get into if you want a quick return. So it was 2020. I obviously had at that point the capital because I'd had an exit. I realized that I probably had missed the macro boat for the bull market because things were starting to turn. So in terms of public equities, I felt that I wasn't going to get the kind of returns that I would have done had I had the liquidity 5 years prior. So I was looking at alternative places where I could place a bet, if you will, on a future return. And I've always been very fascinated by tech, very keen to utilize tech wherever I can in delivering efficiencies and optimizations in the businesses that I've owned, run, and bought. So I actually got into angel investing initially because a company that was adjacent to the space that I was previously in a business in, so the business that I sold, this company that vocational training were looking to set up their training operation, and this wasn't tech. This was good old fashioned humans doing good old fashioned work, but completely naive to any kind of tax benefits or whatever. I wrote a check to be a fairly material investor in that organization, and was with them following the journey of literally getting the thing off the ground, and seeing it through to its kind of break even, and now it's flying, it's throwing off cash for the shareholders, which is fabulous. But it gave me the appetite to back early stage businesses. So for that first sort of, I think I made that investment 2019, and then by about mid 2020, I was thinking, oh, actually, I could probably do a few more of these. Maybe this is the path to. Bearing in mind also, like, we just had a baby boy, or just having a baby boy, so we knew he was coming, and so you start thinking at this age, this early 40s, dad mindset. Well, how am I going to future-proof some wealth for my kid?
Right.
Investing in limited companies currently isn't subject to inheritance tax. So it's a nice thing to be able to do, to pass on shares in companies into a future investment, private companies into a future generation. So that was partly going in my mind, and then I learned post this first angel check, which wasn't hadn't even applied for any of the SEIS thing. I was completely green. I then learned, oh shit, could have actually got some tax relief on that. So but I had the bug, I had the appetite. I thought, no, I'd like to be a shareholder of a few companies on their journey. So I've got the patience to do that. I'm still only 40. If this is a 10-year journey, that's not so bad. So I went looking actively for more, fell in with a couple of angel networks, and everybody was meeting online at this point, right? So it was I didn't really know a world before that where people were going around London pitching in person. Like I came into it when we were all forced to pitch online. So that's been kind of normal for me. And now it will appear that like that's the normal going forward. I think that, typically investors are having their first due diligence call over Zoom, and not as frequently meet the founders as they used to. But yeah, so I fell in with a couple of angel groups, one of which was Henley Business Angels, which I went on to take an active kind of supportive role with the team, kind of leading on growth and trying to do some transformation there to help it get more members and bring more deal flow and that kind of stuff. So, but I invested in a couple of businesses through that. And then I found at the time the Connected platform, and actually was Roy, who runs Connected, was making sure he met everybody that signed up to it. I don't think you can do that now because they get so many signups. It's difficult for the founder to give time to every user, but I certainly loved the approach that, you know, no matter which side of the market you were on, investor, advisor, or startup, he would want to book a call with you as a consequence of you know, signing up, which I thought was lovely. And he gave me a bit of a kind of a primer on the space because he was an ex-Did founder himself in tech with Real Sports. And then he'd started this to try and solve some problems in the startup space. I managed to find a couple of opportunities to invest in through the Connected platform initially. So I think my third and fourth angel tickets were discovered there. One of which is a Antler company that has Fuel Ventures on it at pre-seed, and have gone on to great things. Really great team in AI fintech. And so after a couple of those, Roy mentioned that he was raising, so I invested in Connected as well. I probably over the course of 2 years backed 8 companies maybe. And then then I fell in with the BlockDojo team and had access to investing in some of their deal flow, which was great. And have really then been overwhelmed with deal flow opportunities ever since. I haven't necessarily had to go looking for it, which is both a blessing and a curse to some extent. So most recently I invested in a SaaS for air traffic control called Skyverse.
Right.
Because there's like 35,000 airports out there that are not your major kind of Heathrows and JFKs, but the sort of more regional airports where they're still using bits of paper in plastic and binoculars in the air traffic control tower.
Well, that's terrifying.
Isn't it terrifying? Yeah. So massive opportunity for digital disruption there, and Michael and his team have gone off and built this really amazing SaaS that's taking trajectory information in from all these different sources, radar and flight radar 24 and all this kind of stuff, but using it to help real-time computer-based flight scheduling in ATC towers. And what you've now got is this skill shortage. Look at any industry, any established industry, there's a skill shortage. So you're getting a lot of consolidation of ATCs. And what will be even more scary for you to learn is that there are now ATCs that aren't even on the premises of the airport. So you've got virtual air traffic control towers where it's cameras that are mounted around a pole, fed in real-time low latency signal to these virtual ATCs.
Low latency, yeah.
Don't you, Jess? Yeah. And so now you need some more software because you can't just rely on your paper and your binoculars. He's got CAA, Civil Aviation Authority support, had some funding from them, is now being introduced to lots of regional airports. So I mean, without the pun is he's going to fly. I like those.
It never ceases to amaze me how, you know, whenever I speak to a SaaS founder that in a specific space that maybe I'm not too familiar with, there's always a very, very large proportion of their target market that is, you know, using legacy software or not using any at all, and using, you know, outdated. It's crazy. Like we just assume that, especially as individuals who are in the tech space a lot, speaking with a lot of techie people, we just assume, oh yeah, the whole world's operating at this level, right? And it's like, at the very least, they've got one of the old Nokias, you know, but no, like so many businesses still run on pen and paper, and it's and operating at not an insignificant level too. And you know, that's just completely proven that point.
But aren't we told, oh, we're at peak SaaS? Oh, you know, there's no new fresh ideas. There's no new way in which you can bring digital disruption. I say bullshit.
Look, there's a lot of repetition. I think that's what creates the illusion of that. Like the amount of times I'm pitched the same thing is ridiculous. Yes, but there absolutely is a huge amount of opportunity to disrupt and to.
Yep. And to my point about the SMB world and what we're trying to facilitate with BizCrunch is go out and find an established company that hasn't adopted the tech that is out there that could transform their business. But yeah, it was a real surprise to me to learn that planes are bobbing around the world and landing and taking off, and still relying on binoculars and bits of paper. So yeah, that was my most recent. Prior to that, I went into Uji, which is an AI-powered ed tech, alongside Founder Lightning, the dev agency, and sort of EIS fund. Great guys. They pick some really good deal flow, and Uji is tremendous. If you want to onboard new staff and you want to be able to invite Uji to a call, have it listen to your training of a new member of staff, and then it goes away and creates the training program, an assessment, a video, all through AI in the back end, and comes back and says, here you go, I've listened to what you've said in your onboarding, and this is what you can use next time. Wow. Game changer. Cool. Yeah.
We've had Founder and Lightning on, had Startup to Stand Up on. You were involved with them for a short period as well, weren't you?
Yep.
Great guys. Haven't had Roy on though, not yet. One day I'll get him on.
Well, he'll want you on Big Risk Energy. He'll want to reciprocate. He'll have to go and talk about Big Risk.
Does he still do that? I haven't, because once you start doing a podcast, you basically don't have any time to listen to podcasts. I discovered, so I don't know. But is
do you not have them on while you sleep? No, just to ingest.
No,
okay.
It's the last thing I want. Anyway, what sleep? What the fuck is that?
Oh yeah, very true.
I'm a founder.
Yeah, sleeping is snoozing is losing.
Yeah, exactly.
I think he still does it.
That's cool.
Yeah. Although I'm sorry, Roy, I haven't listened in a while. But yeah, so
I need to reach out to him at some point. So yeah, if you want to put
do. What has been a real privilege, just in a short space of time, is meeting so many wonderful people in this space. Like, it has been, as you've probably been able to tell from this conversation, I'm not shy in offering my opinion. And to be able to sit back and listen and watch, and not be the smartest person in the room, and to just take learnings from every meeting with really super smart, super ambitious people is humbling. It is wonderful, and I it's actually quite addictive. It's a bit of a drug, as my wife tells me. So yeah, it's been a privilege. So who knows what lies ahead.
If you are enjoying this episode and want to support the show, please like, subscribe with notifications turned on, and let us know your thoughts and opinions in the comments below. This lets YouTube know we are doing something right. Back to the show.
So no, sorry, I was just about to say, I think one of the interesting things I see quite often happen with this sort of the startup world, the ecosystem, whatever you want to call it, is a lot of people enter into it initially with sort of these ambitions of great success and making money and all that, but then they very quickly either they get chewed up and spat out if they hold on to that for too long, or what usually happens is they quite quickly realize that it is just a massive opportunity for personal and professional growth and intellectual growth, and that's really where it is. And like you said, it is incredibly addictive. Like, my entry into it from the sales world initially, building and scaling sales and marketing teams, that was it. That just set me up to being like, yeah, I'm hooked. This is where I want to be, because it's just like you say, there's something extraordinarily satisfying about being surrounded by people who can just offer you so much in terms of intellectual, spiritual, emotional intelligence, right?
And that's what you should probably go into the angel investing world with the spirit of looking for, right? If you are treating it like any other asset class and expecting it to always deliver a return, then it's not for you. If you are,
especially early stage, right?
Yeah. So if you want the 50% tax relief of SEIS, you've got to back super early businesses, and there is a 90% death rate, right? So if you're bucking that trend, you've done well. Typical exits or typical results from a portfolio of angels investments is something like average 3x return, but literally from about 10% of your portfolio at most. So you've got to do the maths on that, and too many angels go in, play at it, do have too much portfolio consolidation and concentration into 1 year or one space, or you need to diversify. over a period of time and over different stages and over different vintages and sectors. Must do that. Don't just go in and back a couple of companies, because probably you'll come away with nothing.
Yeah, good advice. What advice would you say on the other end of it, that or what common mistake do you see founders making with angels, that is one that isn't really often talked about? Because I think there's quite a lot of sort of boilerplate advice that we give to founders about, how to approach potential angels, how to be ready for that. But what time and time again are some of those things that you're seeing that really grinds your gears, that are pretty avoidable mistakes that founders could be correcting for, do you think?
I have a lot of respect for a number of the folks that are out there giving founder advice. I also worry that there's a lot of exploitation that's taking place, and a lot of advice that's being given that isn't quite kosher. So yeah, I don't really want to say too much on that topic, other than you don't believe everything that you are reading as a LinkedIn post or watching as a webinar. They are very much a distilled version of reality, and not necessarily your reality, not necessarily the reality that you will face as a founder. People tend to speak in generalizations, and that encourages founders to, and I've perhaps been guilty of that to some extent, but it encourages founders to try a one-size-fits-all policy or approach, particularly in the due diligence calls, where they're expecting a certain cadence, and that's not healthy, because if you're not having a human conversation with another human, you're going to fail to connect, right? It's not a transaction. This is a long-term partnership. This person is investing in your company. You are going to be, to some extent, answerable to them in a small way. You're protecting their interests in some way, and they've supported you in some way. So you need to be cognizant of doing that with people that you want to work with in some fashion. And so if you don't connect on a human level, there's something that's probably not going to go well there, regardless of how great your product is and how great the market that you're serving is. I mean this at pre-seed. It's less that the bigger the company gets, the more tangible the company gets. But at pre-seed, investors are investing in you as a person with your idea, backing the solution that you've come up with to a problem that you've identified. And so it's really a human equation at that point. There's lots of folks out there that are saying, here's how to approach VCs, and that works with angels. It doesn't. It's not the same. It's very different. Angels are working under a different set of criteria, a different set of conditions. They've only got themselves to answer to. It's their money. VCs have a fiduciary duty to their investors. They can't take the sort of risks that angels can take, and they don't get the same mitigation. They don't get the same tax incentives to do so. So the one-size-fits-all policy winds me up a bit, and the kind of outreach that you're encouraged to do for one won't work with the other. Don't send me unsolicited pitch decks or unsolicited PDs or DPs. I don't think that helps. I think you need to create a relationship. You need to have done some proper research. You need to have resonated with the individual. You need to think that they really are a fit to your cap table, not just another number. And I think part of the exploitation that goes on is feeding off this desperation of, well, if I just go broad and offer myself, prostrate myself in front of everybody, surely I'm going to find some good people there. And I think it's quality over quantity, really. You need to find people that you're going to be able to connect with and resonate with, that get your journey. Don't just scattergun the world. And because more often than not in this space, you're going to get responses from people that want something from you rather than people that want to contribute something to you. And that's the point I was making at the very beginning, 2 hours ago when we first started speaking. There's a lot of sketchy shit that happens in this space, and founders need to be prepared for that. There's too many people that want to have your shirt off. It's the Wild West.
A lot of founders I work with experience that. We've had some that have gone back to me who are currently raising that I'm working with as advisor, and they're like, oh, I just received this message, and I'm like, nope. Nope, that's not how it works. You're not meant to pay anything, and there shouldn't be any fees, and this, that, and the other. Like, it's incredible how many times I'm told that these kinds of things occur still, and I thought this would have died down a bit, but yeah, and as you
I
know,
think it's
when
got
we first
worse.
spoke, oh yeah, 100%.
I think it's being done with impunity now. You've got people that are investing under SEIS with the full expectation and condition that they get to earn their money back inside the first year, and they get their investment for free. I mean, what's that about?
Yeah, it's incredible how brazen a lot of it is now as well. With some of it even being like plainly spelt out on websites and things like that. It's insane. It's absolutely insane to me. But as you know, I think when we first spoke, whenever it was a couple of months ago, one of my motivators in the sort of mentoring and advising stuff that I do is to cut through the bullshit, hence the no bullshit advisor thing, right? And it was just incredible how when I first started in this space doing that the people that I had originally kind of sort of come up with and admired and thought, were very quick to move into these more predatory sort of tactics and approaches. And it's just incredible how quick people get sucked into that once they've got a bit of experience behind them. Maybe they've had some moderate success, and therefore they can speak with some authority on the topics that they claim to speak about, and evangelize on. And then suddenly they get sort of sucked into that. And I remember just seeing that around me and then being told and encouraged to do the same thing. I was like, wait a minute, this is absolute bullshit. Like, to your point about, off the shelf boilerplate kind of advice, I think is so dangerous because it completely misses the nuance of the situation. Like in my sessions, I say that right from the beginning with everyone. I say, you're going to talk for 45 minutes and I'm going to ask questions for 45 minutes before I even give one tiny bit of advice to you, because of your situation, your personal circumstance, your financials, your business, your ICPs, like everything is entirely unique to you.
Yeah, so it's your lived experience.
Right. So what I would advise to you is going to be entirely different to the next person. Even though on the face of it might look the same, like the same company, same industry, same sort of type of business. It's like, no, that's not, I'm not going to tell you to go all in on this if you've got 5 kids and a mortgage where you know what I mean? Like, it's going to be very different advice to you than it's going to be to, a kid that's just come straight out of university and it's got, nothing to use in a trust fund. It's like, you know what I mean? Look, where's the responsibility in giving out this advice? And I know that I'm always very aware that doing a podcast can sometimes I'm scared about how that can contribute negatively to that.
Well, I think your approach is much more authentic, though, in so much as you want to have a conversation. There's not necessarily a pitch.
Right.
I'm not sure if I've never really looked at your podcast as being a funnel for work for you. I think you're curious about the sociology of the space.
As well.
Yeah. Well.
yeah. But
that's not a healthy mindset, is it? Right? I mean,
no.
I kind of think that if you give into the universe, then things should come back to you. But I mean, going out and taking,
but that shouldn't
from
be the reason
universe,
to do it.
No, it shouldn't be. Yeah. But that is perhaps how sometimes our contributions are validated and rewarded. But you shouldn't be going out purely with the intent, I'm going to give up this time if I'm going to get something back. Some of the best results that I've had in just from emotional and intellectual kind of reward have been just through conversation and not going in with any particular plan. And I guess that maybe sounds a bit bourgeois, but to your point about folks that have worked their way into a more predatory model, even though they've had some success, that seems like completely on its head to me, because surely in the pursuit of success, you should then be able to not be shilling things. You should have a bit more relaxed approach to the outcome of things. I mean, when do you need to still stand on necks at that point?
I don't think it's intentional. I think it is just that things, let's face it, the shortcuts by definition usually mean that someone has to get screwed over, right? And so if people are taking shortcuts, I don't know, following a success, or wanting to contribute in some way after the fact. Sometimes is what it's to do, again, going back to ego, it's to do with people wanting to continue on like they have some sort of standing within a community, maybe after a failure, or after a moderate success, or maybe not the success that they quite hope for. And so I've seen that. We aren't going into too many details naming names. I've seen that.
No.
And as a result of that, that's where people seem to be. And also, I think there is a certain, bad ideas are like viruses. They spread too. So if you see bad practices that for some reason in certain spaces are just deemed to be the standard, like, they spread. And I remember that was at a point where I really turned things around for myself from a sort of consultancy advisory perspective was a couple of years ago, shortly after COVID, where things really boomed, just as everyone was coming out of that in this space. And people were telling me, like, you're not charging enough, you need to charge more, you should be making sure that you're encouraging them to then go on and, take this amount of equity and do this and this and this. And it was just like, wow, okay, so you really want me to take as much as possible from these people. That's what my mentors and advisors were telling me to do. I was like, that doesn't feel right.
I'm glad you've got the moral compass to navigate that properly, because I think a weaker mind individual might have gone, yeah, okay, fine, this is lambs to the slaughter, let me be the slaughterhouse.
And that's my point. I think because it's framed in such a way of like, this is standard practice. And if you're not doing this, then you're not a professional. And so that's why I think it's so easy for so many other people to then end up getting caught up in that.
I like to be able to recognize myself when I look in the mirror.
Exactly. And that's what I was struggling with at that point. I tell people that I was struggling to sleep, even though I've got insomnia. I had a particularly bad bout of it at that point. I was like, well, this, at the end of the day, you've got to be doing what sits right. And then that's when I introduced the pro bono hour for everyone, tried to democratize it. Because the problem I was having is I was speaking with people who really desperately needed the advice, and they were priced out. I was like, I'm sorry, I can't help you. I was like, that isn't right. They desperately need. They've got a great idea. They've got this. That isn't right. But this isn't the point of what we're trying to do here, surely.
Yeah.
So
I love that though, that you've made time available for people that need it for free. It's almost like based on affordability. Yes, we can go deep and do this kind of work, and yes, that attracts a fee. But actually, if you need this kind of work or this kind of assistance, then I'm happy to do that pro bono. That's beautiful. And I've done it. I mean, I haven't quite structured it in anywhere near that way, but back when I was perhaps had more time and was building more of a portfolio, I took a very much a similar approach. Like, you can have my time for free for a bit, and when we reach a particular milestone where you can afford to to utilize me going forward, I'll say, look, I think you're on your feet now, and if you want to continue, then it might need to be chargeable. I think that's that proved to be fair. Some folks were like, yeah, well, your advice has been indispensable. Can I have an hour a week with you or whatever? And that was remunerated. And others were like, thank you so much for what you've done. Off I go. And totally cool. Everybody's walking their own path, and that's how it should be.
Exactly.
Yeah, of course, it's a good outcome. If you help people move the dial in some way, then you should be able to feel good about yourself. It isn't about whether that's put pounds in your bank account or not. But
right, exactly.
Maybe that's just again a bourgeois view from someone with my lived experience.
No, but I agree with you, and you're right. Yeah, maybe it could be seen as that, but I honestly don't care, because I got to a point where I'm like, do you know what? I don't really care what other people think in this industry anymore. I'm going to just do what feels right, and I think that's what we all have to.
Are you finding though that some of the practices that you're seeing are leaving you feeling a bit jaded about it? Because I mean, I've gone through quite the roller coaster of going in kind of like this. Did you ever watch the music video for Another Chance? I'm showing my age now, but a girl walking around a city with a big heart, and she finds that she's kind of turned away at every door, and people in this big city just don't have any time for her. And by the end of it, she's holding this little heart, and she goes, someone sits down with her on these steps in this kind of like Brooklyn kind of townhouses and goes, oh, is that your heart? And she goes, yeah, it used to be bigger. And like, it's just watching this person visibly go from this kind of like naivety of like, hey world, I'm here for you, to like, oh my God, what the hell is all this? And I kind of, that's not me, but there's a kind of like been a bit of a parallel of like, I've gone into this whole space with like wide-eyed, bushy-tailed, fresh-faced. I've come out of this kind of very mature, commodified sector of industry, and I'm like, wow, tech, what? And then here I am 4 years later, and I'm like, Christ, there's a lot of shit that goes on here. This is where I want to be. I don't know. Is that just
somewhat jaded? But at the same time, I think my very early sort of interest in things like evolutionary biology, human psychology, sociology, all that kind of stuff meant that I wasn't going in it with any kind of disillusions of like, oh, humans are inherently always going to do the right thing. Like, it's messy, it's chaotic. There's more to it than that. That the motivations for people to doing bad things aren't black and white. The motivations for doing good things aren't black and white. Like, so I think that, yeah, there was some element of that, but I also, I kind of knew what I was getting myself into, because of whenever you have people, there's always complexity. Like, politics rears its heads everywhere. People are always trying to get ahead. It's survival of the fittest. It's Darwinian. It's like, it's cosmic chaos. It's like, it's all those things. So it's like, from that sort of philosophical almost approach, it was like, oh, okay, this makes sense.
But there is almost like a polarization and distillation that goes on, like with these kind of accepted practices. It becomes in and of itself like a convention in an industry. And you hear about people referring to the startup space as the venture industry. And the industry isn't always just the VCs with their 2 and 20 model. The industry is like people charging founders that need the money, like for services they don't need to be buying. And there's the disproportionately high amount of that predatory behavior that goes on, going after companies that have just maybe raised their limited amount of pre-seed and are now kind of like lambs to the slaughter. And you see companies, burning through disproportionate amounts of capital because they kind of haven't had the discipline to be able to resist against that, or they've been duped. It just worries the heck out of me. I mean, I'm sure that's present in every asset class and every industry space. I'm sure there is that kind of element of exploitation. It's just I've seen too much of it, and it's kind of left me feeling a little bit cold. So perhaps that's created in me the mindset whereby, look, I've got these 33 portcos now. I'm going to just follow on, look after them, stick around. I haven't been taking on anywhere near the number of angel investments that I was. And I read the same from the likes of Alex McDonald and Nick Telson, and where they're publicly saying, look, hey, my days of angel investing are kind of coming to a close. I'm going to be doing this now. And so for me, this has been kind of going back to the M&A space and looking at ETA and going, this is probably where we're at the vanguard of the next movement, where there's going to be some real value creation, I think, and value opportunities. And it doesn't yet have all of the predatory shit that goes on in the other space that I spent the last 4 or 5 years in.
Yeah, but I mean, just to play devil's advocate on that, and I know we've gone slightly over, so I'll let you go in a second. But I appreciate you going slightly over. But just to play devil's advocate on that side, isn't that contributing in somewhat to the problem? Because if we've got good angels that have the right motivations, the heart in the right place, the experience, etc., why moving them for them to purposely decide to pull themselves out of that space? Don't we need more of that? Don't we need more angels mentoring the next generation of angels and instilling in them the same levels of conviction and the moral compass? And like, isn't giving up the exact problem that isn't going to stoke the fire even more? Not to say giving up is maybe the best term, but you know what I mean? Like, isn't pulling away from that in some ways just going to potentially make matters worse? Don't we, if anything, need even to double down on it, to convict even more in it?
Yeah, it's real food for thought. Maybe there isn't enough advocacy for treading the right path in angel investing, and maybe there's too many loud voices saying here's how to exploit it. Maybe I don't know. I certainly don't intend to vanish, but and I'm always happy. Just yesterday, I was sharing some kind of insights with a fairly new angel investor who's building their portfolio and was sort of trying to calibrate to a few things. And I'm always happy to share limited sort of experience that I've had and some of the things I've observed. I'm not going to vanish, but similarly, I think it's important to diversify.
Right, fair enough. That's a good answer. But have a think about it anyway.
I'll do, Greg. Food for thought.
Yeah, good. Well, I'm glad to leave you with some food for thought. Listen, man, I thank you so much for joining me. I really, really appreciate it. It's been really informative. I've come away with so much to think about myself, which is, again, why I love doing this. And is there anywhere that you want to direct people to? I'll obviously put your LinkedIn profile and stuff like that in the description of this episode, but is there anything that people should be checking out to find out?
Yeah, the LinkedIn profile says it all. It links to all the stuff that I'm involved in. If you've got an interest in entrepreneurship through acquisition and going that route rather than the 0 to 1 route, then start your journey at bizcrunch.co. We'd be more than happy to be your Sherpa in that sense. which I'm definitely going to use more of. But no, it's been an absolutely enjoyable honor to be with you for the last couple of hours, Greg. If I'd have known that we'd be going into all these different spaces of sociology and psychology, as well as the things that we talked about pre the podcast, yes, I could never have expected it to be so diverse. So thank you so much for giving me the privilege to do so.
And we'll absolutely have to do it again, because I feel like we could still go for longer, probably, by the sounds of it. So, yeah, awesome, man. Really, thank you. Really, really appreciate you joining me. And hopefully we'll catch up again very, very soon.
Yeah, I should hope so. Maybe with the beer next time.
Sounds good. Deal. All right. Take it easy. See you soon.
Cheers, Greg.
Bye-bye.
Thank you for listening and/or watching. Please like and subscribe. Or if you are listening via podcasting service and want to show your support, consider rating or leaving a review. It really helps. See you next week.